All right, so if you're watching this video, you're probably one of two types of people. Number one, if you're making money and you want to start investing, you either have a business or you have a career and you want to get started in protecting your wealth from inflation. Or number two, you're already investing, but you're kind of an amateur at it. You don't really know what you're doing. You're making decisions off of random tweets you see or random videos you see on YouTube. Well, don't worry, this video is going to clarify everything for you. We're going to cover what I would do if I started investing in 2024. Now, who the hell am I? Well, I'm Elias Marshall. I started investing in 2017. I'm not an expert. I've only been in this for 7 years, but if you imagine a college class where the student is here and the professor is here in terms of knowledge level, I'm like a TA kind of in between, like a tutor. So I'm not an expert, but I've learned a couple things in my time. I'm certainly not a beginner. I help turn entrepreneurs into investors. You can click the first link in the description to do that. Okay, so in this video, we're going to clarify your goals around investing. I'm going to show a few different strategies that we can go with. I'm going to show my personal strategy that I use. And then at the end, I'm going to shamelessly pitch my newsletter to you. So you've been warned. Now, the best investing strategy for everyone is the one most likely to help you reach your goals. And so before you even begin to start spending money on anything, you need to clarify what you want. And that can be different for different people. For some people, success in investing is never having to work a manual labor job again. You have enough money stored by that you can quit and you can do other work, but you'll never have to go back to the construction site. For other people, it could be putting kids through college, give them a chance that you never had. For others, it could be growing your wealth and protecting it from inflation. So you need to figure out your goal because that will clarify your risk tolerance. If your goal is one of the first two, then you're probably going to be more conservative with your investing. You don't want to take massive risks. If your goal is massively growing your wealth, then maybe you will take more risks because you want to make tons of money. If your goal is protecting your wealth, then you'll take less, etc. So you need to think a long time about why we're even getting into this game in the first place. And so before you buy anything, that's what I just said. Clarify your risk tolerance. Now, one thing that's really important to understand in investing is that risk equals opportunity, and opportunity also equals risk. And so, especially in the markets, there is never a free lunch. You're always taking risk somewhere. And when you're getting higher and higher returns, there is always higher risks associated with that. So we're going to cover a low risk strategy, a medium risk strategy, and a high risk strategy in this video. Now, risk is not the only thing that you want to consider before you buy anything. You also want to think about what style suits you the best. You see, for some people, they're all into real estate. They really like buying residential properties or commercial properties or strip malls, and that's their form of investing. For other people, they just like to buy passive index funds. For other people, they like to do stock picking. For others, they have a bit of everything. They have enough money that they can spread it out. And as you can see here, I listed some of the pros and cons of these different strategies. Real estate has been historically safer, more proven over a long time. And especially if you're in America, you can get good tax benefits, but it's not very liquid. If you want to rebalance your portfolio or if you need to get money quickly, it can be very hard to move it around. Passive index funds have been a proven wealth generator over time. They're more liquid, but you get less short-term upside compared to stock picking. Stock picking has a higher risk and a higher reward. However, most people are very terrible at stock picking. But it's also very fun compared to the more boring passive index fund investing. And then a bit of everything should probably be the end goal if you want to become very wealthy. You want to have some index funds, some real estate properties, some gold and silver, a little bit of Bitcoin maybe if you're feeling crazy, some individual stocks, and then some bonds. So think a bit about what strategy suits you best and your personality best, right? If you have a full-time job or a business, you don't want to be doing stock picking because that takes a lot of work. You have to analyze the balance sheets of these companies, keep up with earnings, follow the macro economy. You will be better off with the more passive forms of investing. If you're recently retired and you want to get into stock picking, that could be an interesting path, right? You could take a portion of your portfolio and do that. So think about what suits you best. How do I go to the next one? Okay. This video is going to mostly cover long-term index fund investing because it's what I'm most familiar with. And I think it's a good path for people who are starting out because you can start with $100 a week and begin investing in your future. Now, what is an index fund for people who are beginners? It's a type of investment fund designed to track the performance of a specific market index. So the S&P 500 tracks the 500 largest American stocks. So if you buy the S&P 500, you are buying tiny shares of the 500 biggest companies: Nestle, Coca-Cola, Meta, Amazon, Apple, etc. And that's the S&P 500 is one type of index fund. There's another index fund called QQQ, which tracks the 100 largest American tech stocks. So that would be Nvidia, Microsoft, Apple, Tesla, Google. And so baskets of index funds gives you a broad, diversified group of stocks, and that helps protect the downside. Because if one stock plummets and the other ones are still rising, your money is more safe. And also vice versa. If one stock goes up but the others go down, you make less returns, but you're a little more protected. And so over time, investing in index funds has been better than buying individual stocks for the vast majority of people, because most of us don't have time to look at the earnings calls of every company, to look at their results every quarter. Now, where can you buy index funds? This is a common question from beginners. Well, you can buy them on any online brokerage. If you're in Canada like me, I'm so sorry. No, I'm kidding. You can use Questrade. That's what I use. I listed some other ones here for America and the UK, but really you should just do your own research. Look up online the best online brokerages to use to buy stocks. Make sure that you can buy American stocks with them. And yeah, you can buy index funds on any online brokerage. And I already covered this. Why are index funds so great? It's because picking individual stocks is very hard. If you have an index of stocks, it allows you to capture the gains of those companies and minimize the losses. This plays into my strategy when it comes to investing, which is I am dumber than I think I am. You see, Warren Buffett says to invest in companies that could be run by idiots and still succeed. It's a very smart investing strategy. And I say construct your portfolio so that even if you are an idiot, you will still succeed. You can go through any subreddit, any Discord server filled with investment types, and you can see tons of losses from people that made idiotic decisions who didn't think that they were idiots, right? Everyone thinks they're smart. Everyone thinks they're smarter than the big banks, than the hedge funds, than the multi-billionaires that focus on this all day and have done for decades. You're not. When you're entering finance, you are the tiniest, not even a fish. You're like a krill. You're like a barnacle in the ocean that's not even as big as the Pacific Ocean, in an ocean that's as big as Jupiter. You are such a tiny piece of the puzzle. You have no idea what you're doing. You're just riding these insane waves. And so you need to really look in the mirror and say, hey, if I haven't been in this for a decade, and I haven't been in this for a decade, I've been in this for 7 years. If I haven't been in this for a decade, year in, year out, I barely understand what's going on. And even after a decade, you've only experienced one type of market condition. If you grew up in a time when stocks do well, but bonds do badly, you're going to be biased towards stocks in your head. If you grew up in a time when real estate did well, but stocks did badly, you're going to be biased towards real estate. So you need to understand that there is so much about this world that you don't understand and that you never will. And you need to always assume that you're an idiot, because investing is one of those games where you could do great for 10, 20, 30, 40 years. And you could make a few terrible decisions at the end of that and lose it all. So you always have to be humble and remember that you're an idiot. I am too, so don't worry. And so in that sense, I found it can be helpful to have multiple portfolios, in the idea that if you're an idiot, so you can have your main portfolio, which will have maybe some index funds, some tech, some energy, some precious metals, a little bit of Bitcoin. You can have your degenerate portfolio where you just act like an idiot, buying dog coins, buying individual stock picks, doing swing trades. You can pretend you're smart here and keep it confined to the degenerate portfolio. Keep the contagion from spreading. And then you can have the what if I'm an idiot portfolio. And this one is super diversified. You have index funds from stocks from all over the world. You have REITs in there, which invest in real estate. Super diversified, super long-term. And even you could have it managed by others. Maybe this is not an index fund that you buy on a brokerage account. It could be a mutual fund managed by some dude at your bank. Now, a lot of us scoff at mutual funds and scoff at the boomers who run them, but you got to assume you're an idiot. And so it can be helpful to have portfolios that are managed by other people so that even if you mess up here and you mess up here, well, ideally, this one stays alive and you can still retire one day or buy a house or put your child through college, etc. So it can be helpful to have multiple portfolios if you're assuming that you're an idiot, which I think you should. I think everyone should. Now, why are we being so cautious? Like, why can't I just have one portfolio and I'll be smart? Well, it's because compound interest in investing is everything. This is the key point to all investment. This chart here shows that if you started with $50,000 in an investment account and contributed $1,000 per month at 10% annually, which is a good return, then 30 years later, you would have 2.8 million. And you contributed, what is that, like around 200,000? You contributed 200,000 total, but because you're growing at 10% annually, you end up with 3 million after 30 years. And so that's what we're trying to do in this investment game, is you're trying to compound over the long term. That's why it's so important to start when you're 18, 19, 20, 21, 22, 25, 26, etc. It's always the best time to start investing was 20 years ago. And the next best time is today, because compound interest is the game. And that's why we're being so safe. We're being so safe because it's really, really easy to lose money and harder to gain it back. If you have $100 and you lose 50%, then you have $50. Now, if you have $50 and you gain 50%, you have 75. Do you see that? So you lost and gained the same percent amount, but you ended up with less money. And so to bring it back, that's why we're being so cautious, because our entire goal is to compound. And the best way to compound is to not lose money. So that's the number one goal: maintain and slowly compound over time. Now that we've got that out of the way, here's a example low risk portfolio that you could do for 2024, that I would do rather. And you should tweak this to suit your investment style. This is not investment advice. This is a example of what a portfolio could look like. 20% technology stocks, 20% energy, 20% T-bills. We'll get into what that is. 20% gold and silver, and 20% international. Now, for the technology stock, we mentioned the QQQ index beforehand. This is a index that tracks the top 100, I believe, technology stocks. You can see here in their holdings, they have Microsoft is 8%, Apple is 8%, Nvidia, Amazon, etc., etc., etc. And you can see the year-to-date return, 1-year return, and 3-year return down here. This is the 5-year chart. Obviously, it's hitting all-time highs right now. So this is an example tech index fund. There are many others depending on how diversified you want to go. And you should do your research when you're choosing these index funds to add to your portfolio. An example energy index fund is the iShares Global Energy ETF. It's got ExxonMobil, Chevron, Shell, etc. And this is one of the example returns. You can see with energy, you're obviously not getting as great returns as you do with technology. However, it is a bit safer and you're more protected in a potential downturn. If you want to have a 100% technology portfolio, you're increasing your risk. You're increasing your opportunity, but you're also increasing your risk. And so we have the energy to kind of balance out the risk of the technology. Now, T-bills, which I mentioned in the portfolio earlier, are short-term debt obligations issued by the U.S. Treasury Department. What does that mean in English? It means you're lending the government money at a guaranteed interest rate. And right now, that interest rate is around 5%. So it's a good, safe portion of your portfolio that's always going to have the value in U.S. dollars that it has, and you're going to get money at a guaranteed interest rate. You can buy T-bills at treasurydirect.gov if you're American, or you can buy an exchange traded fund that exclusively holds T-bills. What's the difference between a T-bill and a bond? A bill is just more short term. So a bill is held for 3 months or 6 months until the interest rate is paid out to maturity, whereas a bond might be 5 years, 10 years, etc. And then gold and silver, which is another portion of the portfolio. In my opinion, physical bars and coins are best, but you can also buy funds on an exchange that track the price of gold and silver. But I think it's good to have it in person. And so that's the lower risk example portfolio that I think I would go with. You capture some upside with technology. You have some protection with energy. You have very safe T-bills and gold and silver. That's 40% of your portfolio is in this super, super conservative holdings. And I forgot to cover international. Let me do that. And then international is just any stocks that are not in the United States. So I'm a big fan of America, but it can be good to have some other holdings. So this is an example index fund of international stocks from developed countries. You can see here they're holding Novo Nordisk, which is the, what's it called? Ozempic company, I believe. There's Nestle, Toyota, Samsung, Shell. So you can get exposure to Louis Vuitton. You can get exposure to these great companies that are not in America. And it helps diversify your holdings too. So even if America has a downturn, but the rest of the world does well, you still capture that. But as you can see, the rest of the world is kind of mid compared to America based on the returns. And then that was the developed countries ETF. This is an example of a emerging markets fund. So this will have Chinese companies, Brazilian companies, South African companies, Indian companies. And again, it just gives you more diversification. Now, this is higher risk. So if I was having 20% of my portfolio dedicated to international holdings, I would probably go 15% of that would be developed, and then 5% would be emerging, just because you're taking on higher risk. As you can see by the performance over time, it's actually negative on the 3-year. And this will give you exposure to, again, international companies in emerging markets. If you want to go for the medium risk allocations, crank it up a bit. We're going to increase tech and energy to 33%, drop international to 15%, drop T-bills to 9%, drop gold and silver to 9%, and add in 1% Bitcoin holdings. Now, why Bitcoin? Well, this is the basic thesis for Bitcoin you should do. You should research it and understand it and read the white paper and be part of the community before you buy any, of course, but it's the fastest growing monetary network in the world. It's compounding at 100% a year, and it has a probability at becoming a reserve asset for much of the world alongside gold, silver, and US dollars. Now, the risk and volatility is still very high. Remember, risk and opportunity are the same thing. So because Bitcoin has a shot at becoming a reserve asset, its value is increasing a lot, but there's a very high risk that it doesn't. And so that's why we're only keeping it at 1%. How do you buy Bitcoin? Well, it's best to buy it on an exchange like Coinbase or Kraken. If you're in Canada, Bull Bitcoin is good, and store it on a hardware wallet. And if you don't know what that means, you should figure that out before you even bother messing with Bitcoin. This is the example high risk allocation that I think I would do if I was investing in 2024. The example is 40% tech, 40% energy. So we've jumped that up. 10% Bitcoin, very high risk. 5% international, drop that down because we're going with higher risk. So we're going to maximize American companies because they're the best. 2.5% T-bills, 2.5% gold and silver for the last 5%. And you can see here 40% tech and 10% Bitcoin is pretty risk on. And you're protected by the energy by a bit and by a little bit of T-bills and gold and silver, but I would call this a high risk portfolio. So let's go over a couple notes, some questions that you may have. Number one is, why is there so much tech and energy? Like, why don't we have, other sectors? That's a good question. You could totally have other sectors and you could do great with other sectors. The reason why I choose tech and energy as the main ones is because of the multiple portfolio theory. Remember, how I like to do this is I have my main portfolio, my degenerate portfolio, and the what if I'm an idiot portfolio. And in my mind, the other sectors like real estate or manufacturing or chemical, all that stuff is covered in the what if I'm an idiot portfolio. These are managed by other people. They're super diversified, super long-term. They're global index funds that cover companies all across the spectrum. Instead of having the top 500 companies in America, it'll have the top 1,000 companies in America and the top 1,000 companies, etc. So that's why I choose tech and energy. You should make your own choice. This is, again, an example, but that's why I run it that way. The idea in my construction is that the energy, the T-bills, and the gold and silver protect you from economic downturns, while the technology stocks in Bitcoin capture the upturns. And the idiot portfolio protects everything. That's what's so beautiful about it. You can be wrong about everything else, and the idiot portfolio is still there for you. So I highly recommend it. It's great. And now my current strategy, because I actually don't really follow that low, medium, high risk. I have a very weird setup. My main portfolio, which I contribute to weekly, is about 30% tech, 20% energy, 15% Bitcoin, 15% T-bills, 50% gold and silver, 5% international. So it's a strange mix of high and low risk. The reason why it's different is that I haven't just started investing in 2024. I started in 2017. And so I understand Bitcoin and the crypto markets very well. And so I'm happy with a 15% allocation. I'm planning to hold it for 5 to 10 years. So when it inevitably crashes, either now or in a year from now, I'll be fine with that. I'm ready for that. I have a plan for it. And let's see, why 15% T-bills? Well, they have a guaranteed return. And so I just like that. I like that risk-free return. And I dislike that, stocks are at an all-time high. On one hand, investing at all-time highs has turned out very well for people. over the past 5 years, and trying to predict a downturn has just led to a lot of people missing out on returns. But on the other hand, it just feels silly to have a low allocation to treasury bills when they're paying at 5%. So that's kind of my thinking here. It's very high risk, obviously, compared to the previous portfolios I showed, but I'm 20 years old, so I'm willing to go high risk, and I have the idiot portfolio to protect me if it turns out I'm an idiot and everything draws down. And if it turns out that I'm an idiot, I'm still protected by the gold and silver, and I can dump the T-bills back into stocks or Bitcoin if they crash. So I think it's a good setup. And this is what I contribute to weekly, every week. And that's another important point. When we set up these portfolios, it's not so that you can dump all the money you have in immediately. It's important to just constantly add to the pile and grow it over years and years and years. Rather than trying to time each market movement, just keep growing your investments. Then I have my degenerate portfolio, which I'm no longer contributing to. I'm only selling, and that's sitting at around 30% Solana, 30% Jupiter, 30% JLP, which is a lending pool for people that use perpetuals on the Jupiter exchange, but don't worry about that. And then about 10% of a stable coin. These numbers obviously change every day because crypto is super volatile. And like I said, I'm only selling from this portfolio right now. I don't want to buy any more Solana or Jupiter at these current prices. I just want to offload them as time goes on. And this is a small part of the overall portfolio. So if this all goes to zero, I'm fine with that. And then the What If I'm an Idiot portfolio, I contribute to every month, and it's not managed by me. It's managed by something called Quest Wealth or something. It's like automatically picked by some expert at Questrade. And so I have my first account, which is the retirement account, and then the second account, which is called a tax-free savings account here in Canada. If you're American, the equivalent to those might be a 401k and a Roth IRA. It could be helpful to have those tax beneficial accounts not managed by you. Now, it's important to note that finance is really hard. It's hard to be good at, and it's hard to understand in the first place, which is almost even worse. And so that's why I created Seer Reports. It helps you to understand the market and make informed decisions off of data and not emotion. Seer Reports helps equip new investors with quality information. If you just read the news or you just read Twitter, you're getting a barrage of noise and no signal. And so what Seer Reports does is it gives you the raw economic data and the best and most important stories of the month so that you can make decisions based off of a rational analysis. So click the first link in the description right now to go from an amateur investor to a professional investor. I'll see you next time.